This is the fourth video of the series Security Analysis for Investments, and in this video we are going to discuss how to find the weighted average cost of capital. This is also known as the denominator. Why denominator? Because when we will study the DCF methodology, that means the discounted cash flow methods of evaluating a particular stock or security. Then there will be two parts. One is your numerator. What is the numerator? Numerators are the cash flows itself. Cash flow is the numerator. Another one is your denominator. And what is denominator? Denominator is your weighted average cost of capital. So in this video we are going to discuss how to calculate weighted average cost of capital. But before that, a little recap of the last video. In the last video we have discussed how to derive the equation for cost of equity. This is your cost of equity. This is written expected value of RI, that means the expected return. So there is an investor who is expecting some kind of return from his or her investment in the firm, and that is the cost of the firm for that investor, and that is called the cost of equity. And we have derived this equation. Here RF means the risk-free rate and RM is the market return, and this RM minus RF, this is called the risk premium, and this is of course the ER. And we have also seen that there were three determinants of beta. One is your financial leverage, another one is your nature of business, and finally the operating leverage. The nature of business is very clear, the type of industry or the nature of business itself. Financial leverage is the ratio of debt to equity, and operating leverage is the ratio of fixed cost versus variable cost. So these things were discussed. Another thing that I just touched upon in the last phase of the video was the levered versus unlevered beta. So the unlevered beta is basically the asset beta. That means the beta for the security, and that is the determinant of type of business and operating leverage, these two. And when we are talking about the equity beta, that is your levered beta, and that is calculated using this type of expression. And when you are converting unlevered beta to levered beta, that means in addition of taking care of type of business and operating leverage, now you are considering financial leverage as well. So these three are included. If you consider only the unlevered beta, that will give you the risk coming out of nature of business or operating leverage only. But if you lever it, that means if you find the levered beta, then you are also considering the financial leverage. Okay, and the method is this. Using this equation, you will convert the unlevered beta into the levered beta. Okay, so let us now rearrange this a bit. This equation is already given to you. Now I will just convert this so that unlevered beta can be written in terms of levered beta. That means this factor is taken in this side divided by this one. So now suppose you have already seen that without even considering this equation, we have calculated the levered beta by using regression. And in regression, either you will use the covariance formula or the slope formula. This we have already discussed in our second video 2. So if you have not seen that, I have given you the link here in the top right corner. Watch it from here. So in that video we have discussed how to calculate levered beta using regression approach. So you may ask that when we have already found levered beta, then why we are concerned about all these complicated things. Remember that when we are performing regression or this covariance calculation or slope formula, whatever, the underlying assumption is what? The underlying assumption is this, that the security we are taking is listed. What does that mean? That means the share price, or say not the share price, the asset price is known to us. The historical asset prices for various days or months or weeks or years are given to us, and the data is available. Only then you can perform this regression or covariance calculation or slope, whatever it is. Without that, if the firm is not listed, a private firm for which your data is not readily available, maybe it is available only in a closed circle. But suppose you are trying to invest a company founded by your friend, so then you cannot calculate this beta levered using this regression approach. So what to do then? Then we will backtrace this beta levered value using this method. So for example, suppose using this equation, that means the transformed equation, beta unlevered in terms of beta levered, we have the beta levered for some listed companies. So for example, your friend has founded a e-commerce business, right? And you don't have any data about that business, but you want to invest, but you know some firms which are listed firms, and they are also in this same business, that means e-commerce business. And so since they are listed, it is easy to find the beta levered using the regression approach. So you are finding the beta levered for these firms, that means these firms of this having similar assets, similar business, and so on. Since they are listed, you can easily find the beta levered for them using the regression approach, right? And using this formula, that means 1 plus 1 minus t into d by e, you can find the unlevered average for these firms. Which firms? These listed firms. Just an average figure. So in case of debt also, you will take the average of these listed firms, average debt of these listed firms, and the equity value also, average equity value of these listed firms. For marginal tax rate also, this was the marginal tax rate. This is also an average figure for all these listed firms. So once this is available to you, this is from regression, and these are the average figures. You calculate the beta unlevered average, and the same things are written here. Average regression beta for few firms having similar assets in the same industry. So from that you can find a total beta. Now understand that so far we were discussing about beta that was related to which kind of risk? Your market risk, right? Now here we have an opportunity to find the contribution in terms of both market risk and firm specific risk. So if you divide this beta unlevered average, that means this figure, this figure, by the correlation coefficient, average correlation coefficient of these listed firms, then you will get the total beta, and this is a measure of both market risk and firm specific risk. So therefore you have an opportunity to find the both to estimate both the presence of market risk and firm specific risk in this case. Okay, so once this is done, then again you lever it back. That means you now have total unlevered beta. From that you find the total levered beta. How to find? Using this equation. So in this case, total beta unlevered into 1 plus 1 minus t into d by e. Now what is this d and what is this e? This is the debt of this particular asset. Means your this friend's e-commerce business. For that business, this is the debt and this is the equity. So in this way we can calculate the total levered beta for your chosen business. So then what is the benefit of this approach? Clearly there are two benefits. One that I have told you. First of all is the firm is not listed. That means you don't have data to find this beta levered using regression approach. And the second benefit is you are able to estimate the total beta unlevered or total beta levered also. And since this is total beta, this is also an estimate of both market risk and firm specific risk. Using the regression approach, you are unable to find this total value. Okay, so this is one additional step I am referring here, that is the determination of beta using bottom up approach. This is the bottom up approach. So if you don't have sufficient data for private firms, for private assets, then you can use this approach to calculate the beta value. Okay, so now let us come to the discussion of weighted average cost of capital. So now please check this illustration. Suppose this is the business. So the central portion, the central drawing, this is the business, and there are three investors: investor A, investor B, and investor F. Why F? I don't know. This should be C or something like that. Okay, and then there is a bank. So there are four sources of capital. One source is from investor A in terms of equity, another is from investor B in terms of equity, another one is from investor F in terms of equity, and then finally from the bank in terms of loan. Okay, so now assume that this is the share. Share means what percentage of capital is drawn from these four sources. So for example, from investor A, 40% of the capital is coming, 10% is coming from investor B, 20% is coming from investor F, and the remaining 30% is coming from the bank. So 40, 30, 20 and 10. This means 100%. Okay, so this is the distribution of the capital. And these red color fonts, red color numbers, these are the expected returns. So for example, investor A expects that she will get 20% of her capital invested. Similarly, this person, he expects that 55% return will be there. Then investor F is expecting that 15% of the capital, 15% of his capital will be the return. And finally, bank does not have any expectation. It has a fixed interest rate, that is 11%. So now what will be your cost of capital? So if you take a purely weighted average approach, then what should be your cost of capital? So I am writing weighted average cost of capital. What should be that? So for investor A, the percentage of return is 25% expected. For investor B it is 55%. For investor F it is 15%, and for the bank it is 11%, right? So now what should be the weights? Weight should be the according to the percentage of share of capital. That means for this is A, this is B, this is F, and this is bank, right? So what is the share of capital for investor A? 40%. For investor B it is how much? 10% only. For investor F it is 20%, and for the bank it is 30%. So this should be the final answer of your weighted average cost of capital, putting this very simply. Remember, when we actually calculate the weighted average cost of capital, the calculation will be not like that. But this is the concept. This is the basic of weighted average cost of capital. So you are getting capital from various sources, and there is a percentage share of each source, and based on the expected return that you need to provide to all these sources, you are calculating the weighted average. That is your weighted average cost of capital. Now let us come how to calculate these things. First of all, please note that it is absolutely impossible that that there is a separate expected return percentage for each and every individual investor. So like in the previous slide we have seen that there are 3 investors, each are having different expectations, but in real life there will be millions of investors, and it is impossible, absolutely impossible, that you just go to every one of them and ask what is your percentage, what is your percentage. That is not possible. So in case of cost of equity, we just simply use our cost of equity formula that we have discussed in video number 3. So if you have missed out video number 3, I will provide the link here. Please go there and check that. Okay, so that is the cost of equity. And what is the cost of debt? Of course, it is not the interest rate that I have shown you in the last slide. It is calculated in some other method. So it is not the interest rate, but it is using some other method. Why not interest rate? Because you don't know what is the source of the debt and what is the actual interest rate, or it cannot be generalized in that way. So then come to the next slide, which is giving you the guideline about how to calculate the cost of debt. So we will calculate the after tax cost of debt, that is the risk free rate plus the default spread into 1 minus tax rate. Now I have given you the links here. So if you go to this link, this will give you the 10 years bond rate. This will be your risk free rate. Just find it from there. And if you go to this link, you will just find this particular data that is already posted here in this slide. So this is giving you the guideline to pick the correct default spread. So remember, this data is not a fixed data. This is always getting updated. So it is always better to go to this particular link and check the data from the website itself. So I will provide these links in the description box. So for example, in order to refer this table, you have to first calculate the interest coverage ratio. How to calculate that? In the numerator, we will have the operating income plus the lease expense. In the denominator, we will have interest expense and the lease expense. So how to calculate this operating income and interest expense using the income statement, that we will show in the subsequent videos. Don't worry about that. But suppose if it is found, then you calculate that and get a particular interest coverage ratio, and then you search it from this range. So see here, greater than this and less than this, the range is given here. So suppose you are finding your interest coverage ratio is 6.5, suppose, for example. So this is lying in this particular range. So you will pick this range. You will pick this range. And what is the spread? Spread is 1.14%. So your default spread will be 1.14%. And tax rate, of course, you will take some average tax rate that we will also see after some time in some subsequent videos. How to calculate the tax rate or how to assume that is not the very big deal. So that is how you will calculate the cost of debt. Now what is the weighted average cost of capital? Weighted average cost of capital is the cost of equity, that means your ERI that you have calculated, and the cost of debt that you have calculated in the last slide, according to the last slide. And what is this? These are the percentage of share. So the total is D plus E, and if you divide E by D plus E, that will give you the share of equity, and if you divide the D by D plus E, that will give you the share of debt. So this is the weighted average cost of capital. So, and what is D and E here? D is the long term debt at the market value, and equity, E is the equity at market value. So how to calculate the equity at market value? That is the number of outstanding shares into the market price of the share. So it is always suggested to calculate D and E in terms of market value. If the market value of debt is not available, or it is difficult to calculate or found, then you can use the book value. So you can use the book value of debt if the market value is not available, but for equity at least you should use the market value. So that means the number of outstanding shares into the market price of the share. So that's all about weighted average cost of capital. This is how you will calculate that, and in the next video we will see, complete this entire process. That means calculating the beta, then cost of equity, then cost of debt, and finally weighted average cost of capital. So these 4 steps we will perform in the next video per particular security, so that the process is clear to you. Then only we will move to the next part of the series, which is the cash flow estimation. So but until then, thanks for watching this video. Thank you very much.